Good morning and welcome to today's webinar brought to you by Antipodes. I'm Matt Dell from Pinnacle Investment Management, the distribution partner for Antipodes. And today's presentation is brought to you by Antipodes Deputy Portfolio Manager, Graham Hay. Graham's responsible for the coverage of the global technology, content and communication sectors. And prior to joining Antipodes in early 2015, he was the portfolio manager and head of research at Perennial International Equities for 6 years, and prior to that, spent 10 years in London as a portfolio manager and analyst for several firms. Now, everyone's talking today about fintech these days, and today's presentation hones in on Antipodes' current thinking on the technology and communication sectors, and also offers some market observations on the distortions caused by sustained low interest rates. Now, before I hand over to Graham, please note that you can ask questions as we go along by clicking on the questions tab on the bottom left of your screen. And now, Graham, it's over to you.
Thanks, Matt, and welcome everyone to the Antipodes webinar, and thank you for taking time out of your no doubt busy day. We're just going to spend about 20 minutes running through some things which we think are both topical and clearly relate to the Antipodes portfolios. Certainly invite questions at the end if you have them. Just starting off on slide number 3, first of all. Just very quickly, the philosophy I think is well captured in this slide as we think about allocating capital. We think about these 3 elements: starting valuation, or the price you pay, the quality of the business that you own, and then how you bring that together at a portfolio level. If you compromise on any of those 3 elements, normally the market will catch up with you, and our goal and ambition is to get all 3 elements right and deliver good portfolio outcomes through the cycle. So just a quick statement of the philosophy there. But really, let's come on to some of the more topical information today, and it is quite topical given recent volatility in markets. If we go into slide 5, we've sort of cheekily included as our first introduction slide a picture of the low interest rate party bus, which has been, as far as we can work out, travelling along for about 5 or 6 years now, replete with various central bankers. I think I see the head of a ETF product fund there, maybe an infrastructure manager or 2. The driver, inadvertently, of course, is heading towards the oil slick that will drive the bus off the cliff, which inevitably tends to happen after we enjoy long periods of one-way markets. And we've been talking about the disconnect globally between interest rates and economic fundamentals now for about a year and a half. And it's interesting that we've had some response in market prices to that disconnect in the last couple of weeks. If you come onto page 6 of the presentation, you'll see graphically what we're talking about, and you can see the historic representation of interest rates both in the US and Eurozone against the components of nominal GDP, that is real plus CPI. And today you can see that low interest rates are a long way from where they might otherwise be when you look at historical regimes. And our expectation, based on what is clearly a healthy and improving set of economic fundamentals with rising inflation pressures, are that interest rates will need to reset at higher levels in order to reconnect fundamentals with the level of interest rates. Now, we know why this has been the case. Central banks have perceived that the patient, the global economy, has been in intensive care for some time now. Our view is that the patient left the hospital probably 12, 18 months ago, has gone back to work, is enjoying overseas holidays and eating in fine dining restaurants. But the doctor continues to apply the morphine and other drugs to ensure that there's no relapse. And that in itself has distortionary effects, and we see that very evident in certain parts of financial markets today. If you go onto slide 7 in the presentation, you'll see some of those distortions. There are many ways in which they're expressed. This picks up on some of the quant work that we have at Antipodes, and what we're really trying to point out here is that the factors of growth and profitability, that is, if you were to isolate those factors, what do you pay for them today versus the historical context? And whilst it's self-evident that we want to own growing and profitable businesses, our point with this chart is to say that in isolation, the price that you pay for that relative visibility today is very high. You can see the two blue lines that are up and to the right are more than 2 standard deviations above their long run average that goes back to 1987. On the other hand, multiple dispersion is very low. The yellow line on that chart, which is another way of saying that the gap between the haves and have-nots within markets is as wide as it's not quite as wide as it's ever been, but it's closer to its all-time widest levels. And so while we have lived at least in a world with low volatility, we live in a world with very high price dispersion, and that sets up things nicely for a long-short manager to take advantage of both sides of that trade. So we think that the recent volatility is interesting. It's not surprising. The timing is always difficult to forecast, of course, but the narrative around inflation and fundamentals is certainly changing, and that is influencing interest rates and having knock-on effects to various parts of the market. If you go on to slide 8 now, you can see the Antipodes global valuation clustering tool. It's a heat map, basically, that shows various sectors and regions. And again, what it's trying to do here is identify pockets of over and undervaluation. The color coding is indicative of that. The orange, yellow, and reds are pockets of overvaluation, and the light blues and into the darker blues are pockets of relative undervaluation versus history. And you can see that over there to the right, looking from the top to the bottom, that financials remain a sector that's very cheap uniformly across the world. And then the other one that has stood out for us increasingly is the communication sector globally as well. And we'll come on to some examples of what we've done in the portfolio in that regard. But this is a tool that helps us organize our research time and think about parts of the market that may not be talked about very often, and allows us to really focus in on where the opportunities are. So coming on to communications, the telecommunications sector is, shall we say, not the most exciting sector in the world these days, but interesting that the extent of the derating over the last 10 years is quite extreme. And what we're not saying with this chart is that everything in the sector is a buy. We think you need to discriminate based on various elements within each country, and they relate to things like regulatory settings, competitive dynamics, and where consumer adoption is on various technologies. But we think selectively there are some very good opportunities globally in the telecommunications sector. One that we've been talking about for a little while now, and we profiled in a recent quarterly note, is the company called KT Corp. It's the former state-owned monopoly telecom provider in Korea. They're the number 1 fixed line operator and number 2 mobile operator in that country. And we really see this, as the essential infrastructure of the digital economy. And in an era where assets like airports and toll roads have been prized for their characteristics, we find it interesting that what is essentially the beating heart of the digital economy, telecommunications infrastructure, is trading at incredibly low valuations. In fact, they're trading on a fraction of the valuations that you would pay for some of those other types of infrastructure assets that I mentioned. And KT is, I think, uniquely positioned. Historically, the company and the sector, for that matter, has been not favoured by investors because CapEx, there's been a constant drip of CapEx that has absorbed all of the cash flow that comes out of the business. But in the case of KT, we think a lot of that CapEx has been front-loaded, such that as we enter the era of 5G in the next few years, we think that the relative risk to CapEx is low. And the reasons for that is that KT have one of the densest cellular networks of any country in the world. That matters because as you add more radios to towers, a big part of the cost is the construction of the tower itself. but because the density of their network is so high, we think that risk is quite low. And then on the fixed line side, Korea and KT in particular have already very strong representation of fibre. It covers almost the entire country and allows the company to deliver 1 gigabit per second speeds, more than 40 times the realised speeds that you get here in Australia on NBN, to a vast majority of the household population in Korea. So again, when you think about the infrastructure as it exists today, we think the capex risks around KT over the next few years are actually relatively low. And then when you think about some of the other elements to this story, it becomes even more interesting. KT have a vast real estate portfolio, not something you'd ideally find inside a telco, but that's the history of the company. On a mark-to-market basis, this real estate portfolio we think is worth around $8 billion. That number exceeds the current market cap of this company altogether. So if we were to X that out, you're getting the underlying telecommunications infrastructure for almost free. A section of that real estate's been carved out into a separate legal entity called KT Estate and is operated as a real estate operation with income. But we think that could be certainly highlighted by management and or parceled off via sale to unlock value. The other element of the KT story we think is interesting is the dividend. The payout ratio here has been historically quite low, around less than 30%. But if you go into page 10 on the slide presentation, you'll see that there's historically quite a tight correlation between payout ratios in amongst Asian telecom companies and EBITDA multiples. And we've highlighted two here on the page, KT, obviously the name we're talking about, and Chunghwa Telecom, the leading integrated operator in Taiwan. Now, Chunghwa Telecom is on various measures not one of the world's best telcos, but it trades on a very high valuation because it pays out the vast majority of its income in the form of dividends. And the investor base in that country prize dividends like nothing else. Also a symptom of low rates. So we think there's scope for KT with their starting point of having low levels of leverage today to grow their dividend substantially over the next 5 years. At a minimum, could go to 50% payout ratio, but in line with more mature, low capital intensive telcos, could easily go to 80% over time. And based on the correlations that we observe, that could result in a substantial re-rating of the equity from around 2.5 times EBITDA today, from anywhere from 6 to 8 times EBITDA. So whilst the sector's not terribly exciting, it's from an investment standpoint, there is a significant upside, we think, in selective names, and KT is, I think, a good representation of that. One of the other names we have in that cluster is Telecom Italia. It's a somewhat unique situation in the context of Europe. It's Europe's last greenfield broadband opportunity in a market with low competitive intensity. In other words, there's no cable infrastructure in Italy, and Telecom Italia's relative market share in broadband today versus other incumbents is the strongest in Europe. And so a somewhat unique situation, also trading at a very low valuation, about a 50% discount to the average European telco. So that fits into that telecommunications cluster as well. So just moving on from telecoms, one of the emerging clusters in the portfolio over the last 12 months has been what we describe as next generation connectivity. And it ties in with 5G, which is on the horizon. Anyone that's sort of followed the press will know that various trials have been going on in certain countries. The Japanese are hoping to have a working network in place by the time of the Tokyo Olympics in 2020, and we'll see commercial deployments in limited fashion from 2019 onwards. But as we sit here today in 2018, where we're in the fourth year of decline of network spending on 4G, that cycle is more or less rolled out, or played out, I should say, and a number of the names that are exposed to that have, as a result, had fairly weak periods of time in their business in the prior 2 years. And we think the time is now to be looking at these types of names, because they will be effectively the enablers of 5G, which we think has the potential to transform commerce and communications with a whole range of new applications, autonomous driving, Internet of Things, augmented reality, and the like, and a bunch of others we've probably never thought of. But the names that we've identified here that are interesting, that we think are well positioned, are companies like Qualcomm, the world's leading intellectual property owner in communications. Company have a very long history of leadership in that space. They also have a very strong chip business, supplying modems and application processor chips to the handset industry, and we think are very well positioned to pioneer the rollout of 5G in 2019 and onwards. The investment opportunity has come about really because of a dispute they're having with Apple. Apple are suing the company over the terms on which they apply their license fees. Every handset company in the world pays Qualcomm a license to use their IP, and Apple have decided that they are not happy with those terms and have stopped paying the company. That obviously had a very big effect on their business and sentiment around the stock, and so that enabled us to buy shares in Qualcomm at what we think are less than 10 times normalized earnings for a business that has a very strong position in next generation connectivity. Nokia is a similar situation. Actually, they have in their own right a very strong IP portfolio that they have, unlike Qualcomm, have actually had a banner year in the past 12 months, signing new deals with companies like Samsung, Huawei, Xiaomi, LG, and Apple themselves. That IP portfolio we think is worth almost half the company valuation today, which means that the systems business, the systems that are used to help build networks, traded a fraction of the valuation of what we think they're worth. So that's similar to Qualcomm, has what we believe ultimately will be transitory factors impacting the share price and creating the investment opportunity. Samsung Electronics, as a memory provider, we think is just simply either direct or indirect beneficiary, depending on how you read it, of more connected devices and faster networks. Memory, as compute gets distributed to the edge, memory becomes an important component of that compute stack. So you can think of, in 5 years' time, fully autonomous vehicles will be like a mini workstation on wheels with a large component of memory and processing capability. So Samsung, by dint of their position in memory, are exposed to this as well. And then the final one is Cisco Systems, a company we've talked about before. It's in fact the largest position in our portfolio today. We have an individual slide on slide 12 if you skip forward. And it's a combination of things. We think ultimately the company benefit just from the massive data workloads that will drive network upgrades as 5G gets rolled out. In addition to that, you have a business model transformation underway at Cisco, whereby they are transitioning to subscription for a number of their products, which drives more recurring revenue and better visibility. And then a growing software portfolio, which we think effectively creates an end-to-end solution that Cisco haven't probably had in the past. In fact, the company reported numbers just this morning, a couple of hours ago, and we see certainly evidence that the story is playing out. The other thing that we think drives the story from here is recapturing share with web scale operators, the Facebooks, Amazons, Microsoft Azure as of the world. Cisco missed that initial wave of investment, but I think under their new CEO, they have recalibrated how they go to market, and I think it's pretty clear that they are regaining some of the lost traction with those web scale operators. So, very much very happy with the Cisco story, and when you look at it on a relative valuation versus other defensive cash generative businesses, it still looks very attractive to us. So why don't we skip forward now? We often get the question, having been proponents of the Samsung story for a number of years now, what about Apple? And although we don't own Apple, we thought it'd be worthwhile reflecting on that business as it stands today. So we've put slide 13 together to sort of canvass what we think that some of the big issues are for Apple. And it really comes down to the core franchise, which is the iPhone. It's 63% of revenues. They have in the 10 years that since the iPhone was launched, they have in some ways revolutionized the market and been a very strong participant in the adoption of smartphones. But in recent years, it's also evident that the company are maybe reaching a natural ceiling, and that is to say, you can see that the chart there, the bar chart shows the iPhone units shipped annually, which peaked in December of 2015. And it now looks like 2018 will be the third consecutive year of relative stagnation of units. And you can see that the line on that same chart is the gross margin, which iPhones are sold. So the company have had constant pressure on gross margins in that franchise as well. Now the chart below that shows smartphone price history and the average selling price of an iPhone versus an Android phone. And you can see the growing gap between those two types of devices over the last decade. So Apple have the tricky dilemma here of having very high price points relative to the competition, and the recent pivot with the iPhone X to raise prices further appears like it has retarded demand relative to what were supercycle expectations. And we're concerned that the company are somewhat stuck with a very high-end niche market, one that's very attractive but could be very hard to grow. The risk, of course, from here is that their ability to sustain that profit pool. This company clearly were a disruptor. I think they've turned into a sustainer. And the question now is, could they become a disruptee? And it's quite interesting to look at moves such as those by Google, who are building an emerging hardware portfolio that includes handsets, it includes home speakers and other devices that could that have the potential to eat away at the Apple ecosystem. And the example that we like to sort of give here is the Google HomePod device is really another way for people to connect online and bypass the traditional avenue of the smartphone. These devices are all voice activated, and at the margin take away the need to operate a lot of services via a smartphone. So that's a potential disrupting impact that both Amazon and Google are trying to pioneer, and could end up being somewhat of an Achilles heel for Apple, although they have belatedly now introduced their own home speaker device. But we think there are parallels with Microsoft in the early 2000s with respect to Apple. Microsoft very much back then defined themselves as a Windows-centric company. And in Steve Ballmer's time after he left Microsoft, he was asked by a technology journalist, did he have any regrets? And his one regret that he was at least willing to admit was that they missed mobile. And the more interesting thing, though, was his next statement as to why they missed mobile. And he said, we missed mobile because we were focused on Windows Vista. It just shows how very successful companies end up being inward-looking and can miss significant changes in the industry landscape as they try to protect their core profit pool. So we're concerned that Apple is at that situation, and that the iPhone, whilst it's a very healthy business today, is susceptible to degradation over time. And just in terms of from a portfolio standpoint, we're not short Apple today, but potentially at a higher price, we could be. We've certainly been short parts of the supply chain which we felt were completely over-egged in expectations of the iPhone supercycle, and that's played out reasonably favorably for us. So moving on to slide 14, just a recap on portfolio positioning for us today. You can see the top 10 names. We referenced a couple of them there, as well as the shorts, not named, but industries in which we're short, and see the major clusters in the portfolio. Our our net exposure in our global long short today is around 63.5%, which has been about the number over the last 12, 18 months, so relatively consistent. And some of the short exposures we have that we referenced there, bond proxy, overhyped growth, we think susceptible certainly in a rising rate environment. And then just coming on to the summary at the end, just to wrap up on what we've covered. As I mentioned in that factor chart, we think the market is on average overpaying for what is perceived to be structural growth. That's in various forms. It could be in infrastructure, it can be in technology, other types of businesses and industries. But it's pretty clear to us that there is a disconnect in valuation for some of those parts of the market. Price dispersion is low. That is, volatility at least has been low, but multiple dispersion is very high, and that sets up interesting opportunities for long-short investors. And then finally, as ever is our job, is to look for asymmetrical risk-reward opportunities, and we think KT is a great example of that, trading at a fraction of the multiple of similar telco companies and an even lower fraction of other infrastructure assets. So I might wrap it up there. We've covered a reasonable amount, I think, in our 20 minutes. And by all means, if you would like to jump in on any questions, feel free to do so.
A member of the friendly Pinnacle distribution team is available to provide further assistance. So look, let's take some questions. We do have just a couple here. Graham, they've got a question here about our exposure to social media. What is it?
Yep, it's a fair question. Social media has definitely been a big part of the investing landscape over the last couple of years. Yeah, look, we've certainly observed with the evolution of models like Facebook as a core go-to franchise for advertisers online. And although we haven't owned Facebook, what we've done is we've pivoted towards situations where we think one of our mantras, of course, is multiple ways of winning, where we think there's an opportunity both to be part of that allocation of advertising dollars to social platforms, but where maybe those assets haven't been properly yet monetized. So probably the best example was an investment in Twitter, which we made last year. Twitter is a unique franchise. We see it as a modern-day broadcast platform, and it hadn't been particularly well managed. Its cost structure was out of line with its revenues, and it wasn't properly monetizing its user base through advertising. But we think the pieces are now in place for those things to be rectified, and for the gap, some of the gap at least, with the price at which you have to pay Twitter to advertise and the price you pay Facebook, some of that gap can begin to close as Twitter gets smarter about managing that asset. Another recent addition in that vein is a company called TripAdvisor. The company, again, a very unique franchise in terms of the percentage of global travel that website touches, valued at just around $4 billion, we think is anomalously low, given the importance that TripAdvisor represents to the global travel community. But again, a bit like Twitter, they've had some issues in the monetization of the platform. We think that at current prices, you pay for none of that potential, and that's the reason we've added to the portfolio. But we think, very clearly, if they can clearly work out a strategy for monetization, that the company have enormous potential. So that's also a recent addition in social.
Graham, a question here on valuations. Generally, on a scale of 1 to 10, where are global valuations currently as a whole, and how susceptible to a turn are they to a potential bear market?
Yeah, very good question. I mean, I think on any sort of CAPE-based analysis that you may see out there, cyclically adjusted PEs, markets do look very expensive. And they've been sustained by low rates and high profit margins, and high share of corporate profits as a share of GDP have sustained markets in spite of that. So I think if, depending on where interest rates end up settling, that will very much, I think, determine where market valuations settle. So we don't try and forecast markets. We look for opportunities at the sector and stock level that fit our criteria. But as a general rule, we've been very cautious on markets, and that's reflected in the net exposure that you see in the fund. And certainly you're aware that any rapid reset of interest rates could certainly undermine market valuations.
A local question here on Telstra. Had a terrible 6 months. What's your view?
Yeah, look, it's a difficult situation, Telstra. The advent of NBN really has fundamentally changed the business model. Obviously, they have a very strong mobile franchise, but the fixed line business has been somewhat relegated to that of a reseller, and I think that makes it a very difficult proposition. I think the longer term opportunity, though, for Telstra possibly is around mobile and 5G, and for them to take back market share from fixed via mobile. We see in various countries where fixed line infrastructure has lagged, mobile has become a way of displacing that, and Telstra's mobile network is probably the best opportunity for them to retake some of that lost NBN share. 5G is a couple of years away before it's realistically a mass market product, but that's certainly a longer term potential upside scenario for Telstra.
Any comments around Microsoft as a long position?
Mm-hmm. Yeah, Microsoft is a top 10 position for us. I mentioned it in the webinar. It's come a long way since those dark days of the early 2000s when they missed mobile and then they ended up in a panic buying Nokia. The new CEO has obviously come to the helm. We think he's done a fantastic job in liberating the company. I think they're no longer defined as a Windows-centric company. But I think it's been in three phases, the Microsoft story in recent years. One was just resetting the goals of the business under a new CEO. That change happened in 2013. Phase two was about pointing the business in the right direction, addressing costs, which the management team there have very successfully done, and then pushing aggressively into cloud. And then phase three, I think, going forward is the evolution of Azure as a platform. And Microsoft have been, having started in a long way behind Amazon, have caught up quite dramatically in the last year and a half, and have been, although Amazon is still growing themselves in their own right, Microsoft's growth rate has been about double that of Amazon for their Azure platform. And we think that this is an evolution of the model that will ultimately mean Microsoft is a much larger, more profitable business with Azure as a platform to deliver their products and services. So the financial opportunity over the next 3 or 4 years is margins. And Azure, for most of its life, ran as a loss leader, but margins have clearly turned in that business now. And so as that margin leverage comes through, we think you get lots of upside in the financials in Microsoft as that happens. So we're very comfortable with the story. The PE is not nearly as low as it used to be, but as the model has evolved towards subscription, a lot of the income is now on the balance sheet and gets recognised ratably over the life of the subscription contract. So we think you need to look at free cash flow rather than earnings. And on that basis, Microsoft still trades at a discount to the broad market. So we see upside still in Microsoft.
Thank you. Question here about gold. We've been in and out of it. What's our current weighting in gold?
Yes, we still have exposure to gold. I'm just quickly running down the portfolio exposures here. Still have exposure directly via the commodity as well as a couple of stocks. Yeah, look, gold, we think in a rising inflation environment can probably do reasonably well. The opportunity a couple of years ago was quite different, where you had at the end of the mining cycle, gold equities had derated significantly, and there was an opportunity, I think, selectively to own a couple of names, which we did. Those stocks subsequently re-rated significantly, and are not nearly as attractive as they used to be, and so we've had a preference for the underlying currency or commodity, however you want to refer to it. But we have stuck with one of those names.
We've got time just for one more question, and it's a sort of a fairly long question, but if I could just paraphrase it on European banks. Do you potentially see any more pain ahead for European banks that aren't priced in? The question here sort of refers to, for example, a high level of non-performing loans in Italian banks. Do you see any further pain?
Yeah, the European banking industry has come a long way. The main, probably the biggest issue is just the underlying health of the European economy has improved markedly over the last 2 years. So that backdrop of rising asset prices, loan growth, and general economic health has provided a much better backdrop for the banks to operate. Specifically in the case of Italy, we have had a preference for what we consider to be the highest quality institutions there. The country as a whole continues to have a non-performing loan problem, but in the banks that we have exposure to, we think we're relatively ring-fenced from that issue. The politicians have taken various steps to try and address the non-performing loan issue, as well as undertake consolidation within the sector. So it's very much an improved situation in Italy. Probably the next major event will be the elections there in April. It's looking increasingly like a centre-right government, which we think is a pretty good outcome for markets. And then I think probably the other thing to note on Europe is the arrival of a grand coalition in Germany with Martin Schulz in the fray. We think that creates the potential for the persistent austerity under which the German government appear to operate to be loosened up, and again, that would be very positive for European economic growth, we think.
Okay, thanks, Graham. Look, we've run out of time today. There was a couple of other questions we didn't get to, so we will follow those up with individual queries. That concludes today's webinar. Now, please note, if you would like further information, please visit the Antipodes website at antipodespartners.com or contact a member of the Pinnacle distribution team. Thank you for dialing in, and have a good day.